The tankers stopped are not moving. Ships carrying millions of barrels of oil sitting still. A narrow strip of water that feeds the entire world's energy is now a war zone. Your petrol price, your electricity bill, your grocery costs, all of it connected to this one route. And the people who should be warning you are completely silent. What happens when 20% of the world's oil simply disappears? The answer is something no government wants you to calculate. Welcome to Currency Archives. Now, before we go any further, if you're watching this right now, I want to ask you something. You know that wise uncle in the family, the one above 50, who always said, "Beta, save your money, hard times come without warning"? He was right. And right now, this channel is that uncle. So if no one has told you to subscribe yet, consider this your reminder from someone who actually cares. Hit that subscribe button, because what we cover here, you will not find on mainstream news. And tell me in the comments, where are you watching from today? Pakistan, UAE, UK, USA? Let me know below. Because what comes next in this video affects every single one of you differently. There's a narrow strip of water sitting between Iran and Oman. It is not very wide. At its narrowest point, it stretches only 33 kilometers. A person looking at a world map might barely notice it. But every single morning, when people fill their cars with petrol, turn on their lights, or start their factories, they are depending on this small stretch of water to function. This is the Strait of Hormuz, and right now it is in serious trouble. For decades, this waterway has served as the main passage for oil moving out of the Persian Gulf. The countries surrounding it, Saudi Arabia, Iraq, Kuwait, the UAE, and Iran, hold some of the largest oil reserves on the planet. But all that oil, no matter how abundant, must pass through this single narrow gate before it reaches the rest of the world. There is no alternative. There is no backup route that can handle the same volume. The Strait of Hormuz is not just important, it is irreplaceable. Every single day, approximately 17 to 21 million barrels of oil move through this corridor. That number represents nearly 20% of the entire world's daily oil consumption. When analysts, economists, and energy experts talk about the Strait of Hormuz, they often use one phrase repeatedly: the world's most important oil choke point. That phrase is not exaggeration. It is a precise description of reality. Now, the ships are slowing down. Some have stopped completely. Reports emerging from the region describe a picture that serious observers find deeply alarming. Oil tankers, massive vessels carrying millions of barrels, are now hesitating before entering the strait. Shipping companies are communicating internally about risk levels. Some vessels are anchoring and waiting. Insurance premiums for ships traveling through the region have begun climbing sharply. These are not small signals. In the world of global trade, when ships stop moving, the entire supply chain feels it within days. The reason for this disruption is the escalating conflict involving Iran. Tensions in the Gulf region have been building for some time, but recent developments have pushed the situation to a more dangerous level. Military activity near the waterway has increased. The threat of direct interference with shipping, something Iran has used as a strategic warning in the past, is now being taken seriously by shipping companies, energy traders, and governments alike. This is not the first time the world has faced tension at the Strait of Hormuz. In 1987 and 1988, during the so-called tanker war, both Iran and Iraq attacked oil vessels in the Gulf. The United States eventually sent naval escorts to protect tankers. Oil markets experienced significant disruption. In 2019, several oil tankers were attacked near the strait, and oil prices jumped immediately. Each time tensions rise at this location, the global economy responds, because the global economy has no choice. But those familiar with the history of this region are noting something important about the current situation. The previous episodes of tension occurred in a world that had more flexibility, more spare production capacity, more stable supply chains, more room to absorb shocks. Today, the global economy is operating with far less margin for error. Supply chains are still recovering from years of disruption. Energy markets are already under pressure from multiple directions. The world's buffer has shrunk considerably. What makes this moment particularly serious is the combination of factors arriving at the same time. Tankers are not moving freely. Oil prices have already crossed $90 per barrel. Shipping companies are recalculating their routes and their risks. Governments are monitoring the situation in real time. And the public, for the most part, has not yet been told the full weight of what this disruption could mean. Energy experts studying the situation are not speaking loosely when they issue warnings. They are looking at data, at shipping movements, at futures markets, at refinery schedules, at emergency reserve levels, and what they are seeing is a system under genuine stress. The Strait of Hormuz has always been the world's most critical energy artery. Today, for the first time in years, that artery is showing its first serious signs of blockage, and the pressure is only beginning to build. Most people see a number on a screen. They see oil at $90 per barrel, and they think they understand what that means. They think it is simply a price. the way a loaf of bread has a price or a bus ticket has a price. They change the channel. They scroll past the headline. They assume that somewhere, someone responsible is managing the situation. What they do not understand is that the number they just dismissed is not a price. It is a warning signal, and it is already out of date. The global oil market does not operate the way most people imagine. Oil is not bought and sold the way groceries are purchased at a shop. The price of oil that appears on screens around the world, known as Brent Crude, is determined largely by futures markets. These are financial markets where traders, banks, hedge funds, and institutional investors are not buying oil that exists today. They are buying contracts for oil that will be delivered weeks and months from now. They are placing bets, highly calculated, data-driven bets, on what the world will look like in the future. And right now, those bets are moving in one direction only. When tension rises near the Strait of Hormuz, traders do not wait for an actual disruption to occur. They price in the risk immediately. The moment a shipping company announces it is pausing operations near the strait, the moment a tanker changes course, the moment a government issues a security warning about Gulf waters, the futures market reacts within minutes. Prices adjust not to what has already happened, but to what the market believes is coming next. This is why the $90 figure is misleading. By the time that number appeared on screens, serious traders had already moved past it. The real question being asked inside trading floors, inside energy ministries, and inside the boardrooms of major corporations is not what oil costs today. The question is what oil will cost in 60 days, and whether supply will even be available at any price. There's another layer to this that rarely receives proper attention. When oil prices rise, the damage does not stop at the petrol pump. The increase travels through the entire economy like a current moving through a wire. Shipping companies that transport goods across oceans run on fuel. When their costs rise, they raise their freight rates. When freight rates rise, the cost of importing and exporting everything, for electronics, food, medicine, raw materials, increases simultaneously. Manufacturers who depend on those materials raise their prices. Retailers pass those increases to consumers. The person who never owns a car, who never buys petrol directly, still feels the full weight of an oil price increase through every product they purchase. This process does not happen instantly. It takes weeks, sometimes months, which is precisely why it is so dangerous. By the time ordinary people feel the impact in their daily lives, the damage has already been locked in. There is also the question of shipping insurance, a factor that receives almost no public attention but carries enormous economic weight. Every tanker that moves through a conflict zone must be insured against risk. When that risk increases, insurance premiums increase with it. Those premiums are paid by shipping companies, who then recover the cost through higher freight charges. Higher freight charges mean higher import costs. Higher import costs mean higher consumer prices. A single spike in maritime insurance rates near the Strait of Hormuz can add invisible costs to thousands of products in dozens of countries. Costs that consumers will pay without ever knowing where they originated. Refineries add another dimension to this problem. Oil does not arrive at a petrol station in the same form it leaves the ground. It must be processed. Refinery schedules are planned weeks in advance. When supply becomes uncertain or delayed, refineries cannot simply switch sources overnight. Processing slowdowns create fuel shortages that are entirely separate from the original supply disruption, a second wave of damage following the first. What serious economists are observing right now is not a simple price spike. They are watching multiple pressure systems collide simultaneously. Futures markets, freight rates, insurance costs, refinery schedules, and consumer inflation, all moving in the same direction at the same time. The $90 number on the screen is already yesterday's reality. The number that matters is the one still being calculated. There's an old principle in engineering. When pressure builds inside a system, it does not destroy everything equally. It finds the weakest points first. It moves through cracks that already exist. It turns small vulnerabilities into large failures. And by the time the damage becomes visible to the outside world, the internal collapse has already been underway for some time. The global economy works the same way. When an oil crisis strikes, it does not hurt every country identically. It does not distribute its damage fairly or evenly. It searches, almost intelligently, for the economies carrying the most debt, the most import dependency, the thinnest currency reserves, and the least political room to absorb pain. And right now, as the Strait of Hormuz tightens and oil climbs past $90 per barrel, 5 economies are sitting directly in the path of what is coming. Each one is vulnerable. Each one is vulnerable in a completely different way. The United States presents the world's most complicated case. On the surface, America appears insulated. It is one of the largest oil producers on the planet. It has strategic petroleum reserves. It has financial tools that most countries can only observe from a distance. But beneath that surface, a dangerous conflict is developing. One that has nothing to do with oil wells and everything to do with the Federal Reserve. America's central bank has spent the last 2 years fighting inflation. It raised interest rates aggressively. It communicated to markets that price stability was the priority above all else. The battle was not yet fully won. Inflation had cooled, but had not been completely defeated. Now, an oil price surge threatens to reignite it. Rising energy costs push transportation costs higher. Transportation costs feed into the price of every product moving through the American economy. Inflation numbers that were declining begin climbing again. The Federal Reserve then faces an impossible choice. Raise rates further and risk pushing the economy into recession. Hold rates steady and allow inflation to accelerate. There is no comfortable option. Both paths carry serious consequences, and the trigger for this dilemma is a narrow waterway thousands of miles from Washington. China is facing a different kind of pressure, one that strikes directly at the engine of its economic model. China is the world's largest importer of crude oil. A significant portion of that oil originates in the Middle East and travels through the Strait of Hormuz. Chinese factories, Chinese power plants, Chinese transportation networks, all of them run on energy that passes through this single choke point. When supply becomes uncertain, Chinese manufacturers face rising input costs. When input costs rise, profit margins compress. When profit margins compress across an economy already navigating slower growth, the consequences extend far beyond factory floors. Export competitiveness weakens, employment pressure builds, government revenues decline. China has significant strategic reserves and long-term supply agreements, but even those buffers have limits, and a prolonged disruption tests every one of them. India sits in a position that analysts describe as acutely exposed. India imports approximately 85% of its crude oil requirements. It is the world's third largest oil consumer. And unlike wealthier economies, India has far less fiscal space to absorb price shocks through subsidies or financial intervention without causing serious damage to its public finances. When oil prices rise sharply, India faces a chain reaction. Transportation costs increase immediately, and in a country where supply chains for food and essential goods depend heavily on road transport, that increase passes quickly into grocery prices. Electricity generation costs rise. The rupee comes under pressure as India's import bill expands. The government faces the politically sensitive choice of either passing costs to consumers or absorbing them through subsidies that strain the national budget. Neither option is painless. Japan represents perhaps the most structurally vulnerable major economy in this crisis. Japan produces almost no oil domestically. It imports nearly everything it consumes. There is no domestic production buffer, no alternative supply base, no geographical advantage. Japan is entirely dependent on the uninterrupted functioning of global oil shipping, and the Strait of Hormuz sits at the center of that dependency. A serious disruption does not simply raise prices for Japan. It raises the fundamental question of energy security at a national level, a question Japanese policymakers have feared revisiting since the oil shocks of the 1970s reshaped the entire country's economic strategy. Pakistan enters this crisis in the most fragile condition of the five. Its currency has already faced significant pressure. Its foreign exchange reserves have been under stress. Its economy has been navigating a difficult stabilization program. In this environment, a sharp rise in global oil prices is not an inconvenience. It is a structural threat. Higher oil prices expand Pakistan's import bill directly. That puts pressure on an already strained current account. The rupee weakens further. Petrol prices rise. And because energy costs feed into electricity generation, power tariffs increase simultaneously, hitting households and businesses at the same time from multiple directions. The pressure systems building inside these five economies are not identical, but they share one common origin: a narrow strip of water, 33 kilometers wide, that the world forgot to worry about until it was too late. History does not announce itself. It does not send formal warnings. It does not pause and wait for people to finish their routines, check their phones, or complete their quarterly reports. History moves, quietly at first, then suddenly and completely. And the difference between the people who survive it well and the people who are destroyed by it almost always comes down to one thing: not intelligence, not connections, not even capital, timing. The people who recognized the 1973 oil shock for what it was, not a temporary inconvenience but a structural realignment of global power, repositioned themselves before the majority understood what was happening. The people who understood the 2008 financial crisis weeks before it became front-page news did not simply protect what they had. They built positions that defined their financial lives for the next decade. In every major economic disruption in modern history, there exists a narrow window, measured not in months, but in weeks, where preparation is still possible. That window is open right now, and serious people around the world are already moving through it. The first group moving with purpose is governments themselves. Behind closed doors, energy ministries in the United States, China, India, Japan, and across Europe are activating contingency protocols that most citizens never hear about until they are already in effect. Strategic petroleum reserves, emergency stockpiles built precisely for moments like this, are being reviewed for release capacity. The United States Strategic Petroleum Reserve, now one of the largest in the world, has been used in past crises to stabilize markets temporarily. Other nations maintain similar reserves at varying levels of readiness. But here is what serious analysts understand about strategic reserves that public commentary rarely explains. These reserves are not solutions. They are delays. They buy time, typically measured in weeks, occasionally in a few months, but they do not replace the underlying supply that a prolonged Strait of Hormuz disruption would remove from the market. Governments releasing reserves are not fixing the problem. They are managing the visible symptoms while hoping the underlying cause resolves itself diplomatically or militarily. When governments begin activating emergency reserves, it is not a signal of control. It is a signal of genuine concern. The second group moving decisively is institutional investors. Inside the world's largest asset management firms, portfolio managers are making quiet but significant adjustments. Energy stocks, companies involved in oil production, refining, and distribution, are receiving increased allocation. Commodity positions are being expanded. Currencies of major oil exporting nations are being studied for strength. Safe haven assets, including gold, are attracting capital that previously sat in more aggressive positions. These moves do not appear dramatically on public markets overnight. They happen gradually, professionally, and largely invisibly to retail investors watching daily price movements. But the direction of institutional capital in the weeks following a major geopolitical energy shock is rarely random. It follows a logic that has repeated itself across multiple cycles. Energy disruption creates commodity price pressure. Commodity price pressure creates inflation risk. Inflation risk drives capital toward real assets and away from paper ones. The investors who understand this cycle are not waiting for confirmation. They are positioning ahead of it. For businesses, particularly the entrepreneurs and young business owners watching this situation develop, the historical playbook offers specific and actionable lessons. Every major oil crisis in the past 50 years produced the same pattern. The businesses that survived and grew were not necessarily the largest or the best funded. They were the ones that had already reduced their energy cost exposure, already diversified their supply chains, and already held enough cash reserves to operate through a period of elevated costs without being forced into desperate decisions. The businesses that struggled were the ones that assumed the disruption would be brief, that prices would normalize quickly, and that preparation could wait until the situation became clearer. By the time the situation became clearer, the costs of preparation had multiplied significantly. Right now, the window for low-cost preparation is still open. Supply chains can still be reviewed and adjusted. Energy cost exposure can still be assessed and reduced. Cash reserves can still be built before credit conditions tighten further. These are not dramatic actions. They are quiet, disciplined, unglamorous decisions, exactly the kind that define which businesses exist 5 years from now and which ones become cautionary stories told in business schools. There is a final dimension to this moment that deserves direct and honest acknowledgement. The Strait of Hormuz crisis is not happening in isolation. It is arriving at a time when global debt levels are historically elevated, when central banks have less room to cut rates than they did in previous crises, when supply chains are still carrying the structural damage of recent years, when public trust in institutions, financial, political, and media, is lower than it has been in generations. This combination of factors means that the traditional shock absorbers built into the global economy are operating at reduced capacity. The buffers are thinner, the response tools are more limited, and the speed at which a regional disruption can become a global crisis is faster than most models currently account for. The people who will look back on this period with clarity, who will understand exactly what was happening while it was happening, are not waiting for a government announcement. They are not waiting for a mainstream headline to confirm what the data already shows. They are studying the shipping movements, the futures markets, the insurance rates, and the quiet repositioning of serious capital. They are the ones asking the right questions right now, not after the window closes, not after the price has already moved. Now, because in moments like this one, the most expensive thing a person can own is the belief that someone else is handling it